Remember this because silver has never mattered more than it does right now, and not because of a headline, not because of a short-term move, but because of where we are in the monetary cycle and what history tells us happens next. Silver does not announce itself when it is about to become important. It waits, it lags, it frustrates, and then, when pressure becomes impossible to ignore, it reasserts its role in ways that catch most people off guard. This is not a story about excitement or speculation. It is a story about inevitability, about systems under strain, and about an asset that has quietly waited for centuries for moments exactly like this one. Silver occupies a position in the global system that no other asset does. It is both money and material, both store of value and industrial necessity. That dual nature is not a coincidence. It is the reason silver has survived every monetary experiment humanity has ever attempted. When trust in money is strong, silver fades into the background. When trust weakens, silver returns to relevance, not emotionally, but mechanically. And today, the mechanics are aligning again. For decades, silver has been treated as an afterthought, overshadowed by gold, dismissed by institutions, suppressed by derivatives, and misunderstood by investors. It has been priced as if it were abundant and optional. In reality, silver is neither. Silver is consumed, not hoarded. It disappears into solar panels, electronics, medical technology, energy infrastructure, and defense systems. Once used, it is rarely recovered. Above-ground silver inventories have been declining for years, even as global dependence on silver has increased. This is not a theory. It is a structural imbalance that cannot be resolved by financial engineering. At the same time, silver has remained tied to monetary confidence. It has served as money for thousands of years because it holds value independent of political promises. When currencies are trusted, silver is ignored. When currencies are questioned, silver becomes relevant again. This cycle has repeated across empires, monetary regimes, and political systems. The names change, the pattern does not. What makes the current moment unique is the compression of pressures that historically unfolded over decades, but are now unfolding simultaneously. Sovereign debt levels are no longer cyclical, they are structural. Governments are no longer managing temporary imbalances, they are managing permanent ones. Debt servicing costs are rising into environments where growth is constrained, demographics are unfavorable, and political tolerance for austerity is limited. This creates a system that depends entirely on confidence remaining intact. Confidence is a fragile thing. It does not disappear all at once. It erodes gradually. Each policy exception, each emergency measure, each monetary expansion weakens it slightly. For long periods, this erosion goes unnoticed. Markets continue to function. Prices remain stable, narratives hold. But beneath the surface, pressure builds. Silver responds to that pressure differently than most assets. It does not react to speeches or optimism. It reacts to outcomes. It reacts to supply constraints, physical demand, and monetary stress. When these forces align, silver does not need promotion. It reprices itself. One of the most misunderstood aspects of silver is its volatility. Many interpret volatility as instability. In reality, volatility often reflects truth attempting to surface within constrained systems. Silver's price has been shaped for decades by paper markets that dwarf physical supply. This structure works as long as confidence in settlement remains high and physical delivery remains secondary. It becomes fragile when physical demand increases or when trust in paper claims weakens. Physical silver does not multiply, paper claims do. This imbalance can persist for years, but it introduces a breaking point. When that point is approached, price no longer reflects speculation. It reflects stress. Stress does not announce itself loudly. It appears quietly through widening premiums, delivery delays, regional price discrepancies, and changes in buying behavior. Industrial demand is a critical part of this story. Unlike gold, silver is not optional in modern technology. Electrification, renewable energy, data infrastructure, and advanced manufacturing all rely heavily on silver's unique properties. There is no substitute that matches its conductivity, durability, and efficiency at scale. As global systems attempt to transition toward new energy and technological models, silver demand increases structurally, not cyclically. Mining supply, however, does not respond quickly. Silver is rarely mined on its own. It is primarily produced as a byproduct of other metals. This means supply cannot be ramped up simply because demand increases. Declining ore grades, rising extraction costs, geopolitical constraints, and environmental regulation further limit expansion. This creates a supply-demand dynamic that tightens gradually, then suddenly. At the same time, monetary systems are under strain. Central banks face an impossible balancing act: tighten too aggressively, and debt markets destabilize. Ease too much, and currency confidence erodes. This forces policymakers into a mode of perception management rather than fundamental resolution. Metals do not respond well to perception management. They respond to reality. Central bank behavior provides important signals. Institutions that publicly downplay precious metals often quietly accumulate them. This is not hypocrisy, it is prudence. Gold and silver represent assets that sit outside counterparty risk, outside political cycles, and outside digital systems. When institutions prepare for uncertainty, they prepare quietly. Silver, in particular, has been historically underestimated in these preparations because of its smaller market size and higher volatility. But that smaller market size is precisely why silver can move dramatically when pressure builds. It does not take large capital flows to overwhelm a tight physical market. When that happens, repricing can be swift. The idea that silver could become one of the biggest breakout stories in history is not rooted in excitement. It is rooted in asymmetry. Silver is small relative to global capital flows. It is essential to modern systems. It is structurally constrained on the supply side, and it remains historically undervalued relative to gold when measured against long-term monetary cycles. These conditions rarely coexist. When they do, outcomes tend to surprise. The gold-to-silver ratio has long served as a signal rather than a target. It reflects relative stress within the monetary system. Extreme readings have historically preceded periods of silver outperformance, not because silver becomes fashionable, but because it becomes necessary. Ratios do not predict timing. They highlight imbalance. What often prevents people from understanding silver is impatience. Silver does not reward constant attention. It moves slowly, then suddenly. It tests conviction by remaining dormant while other assets attract headlines. This is not a flaw. It is a feature. It ensures that ownership is deliberate rather than emotional. When silver begins to move meaningfully, it is rarely comfortable. Volatility increases. Narratives shift. Skepticism turns into confusion, then into urgency. By the time silver dominates headlines, the preparatory phase is already over. History shows this repeatedly. Those who understand silver rarely need persuasion. Those who ignore it often feel blindsided. Preparation in this context does not mean expecting a specific outcome. It means understanding the role silver plays within a broader system. It means recognizing that silver is not a trade but a tool for preserving purchasing power, for maintaining optionality, and for navigating transitions. Optionality is the true value of silver. In a world increasingly dependent on digital promises, centralized systems, and uninterrupted confidence, optionality becomes rare. Silver exists outside these dependencies. It does not require permission. It does not rely on networks. It simply exists. This does not mean silver is immune to manipulation or control. No asset of consequence is. But attempts to manage silver's signal tend to confirm its relevance rather than diminish it. Assets that do not matter are ignored. Assets that matter are managed. The coming phase is unlikely to be linear. Silver rarely moves in straight lines. It stalls, it retreats, it frustrates, and then it accelerates. Those expecting immediate gratification often exit prematurely. Those focused on structure rather than speed tend to remain positioned. The concept of a breakout should therefore be understood carefully. A breakout is not an explosion. It is a transition from suppression to expression. It is the point at which price begins to reflect underlying reality rather than imposed balance. When that transition occurs, it tends to be misunderstood at first, dismissed as temporary, and then reevaluated once it persists. History suggests that when silver enters such phases, it does not simply rise. It redefines its role in public consciousness. It shifts from being viewed as speculative to being viewed as strategic. This shift does not happen overnight. It happens as systems adjust and narratives catch up. It is important to recognize that large nominal price discussions are not promises of wealth. They are reflections of currency evolution. If silver were to be priced dramatically higher in nominal terms, it would not represent sudden enrichment. It would represent currency units losing purchasing power. The role of silver in such environments is preservation, not multiplication. This distinction matters because it frames expectations correctly. Silver does not solve problems, it mitigates them. It does not create certainty, it provides resilience. In times of transition, resilience matters more than performance. As pressure builds across monetary, industrial, and geopolitical systems, silver's dual nature becomes increasingly relevant. It is difficult to dismiss an asset that is both essential to modern infrastructure and historically trusted as money. That combination is rare. It is also uncomfortable for systems built on confidence and control. Silver's journey has always been cyclical, periods of neglect followed by periods of rediscovery. Each rediscovery coincides with a loss of faith in prevailing systems. This cycle has repeated across centuries. There is no reason to believe it has ended. Remember this because silver does not move for reasons that fit neatly into headlines. It moves when systems reach limits. It moves when imbalances can no longer be deferred. It moves when trust begins to shift from promises back to substance. Those who understand this do not rush. They prepare quietly. They study history. They observe behavior rather than narratives. They recognize that the most important moves often begin long before they are obvious. Silver has waited a long time for conditions like these. It does not need encouragement. It does not need belief. It only needs time. And time, as history suggests, tends to favor assets that cannot be printed, promised, or engineered into existence.